Now let's take a look at your markets, starting with the JSE. Really a bloodbath in markets today, with local equities getting a negative handover from Asia, and that filtering through. Really the tech sell-off deepening and weighing on global sentiment. And with that, we are seeing most of the losses coming from the resources 10 complex, down almost 2.5%, followed by the financial 15 and the industrial 25, down about 1.4%. And taking all of that into account, the all share shedding 1.7%. Now over in Wall Street, markets that front starting Tuesday in the red. Investors assessing those AI bubble concerns ahead of Nvidia's results, while also eyeing economic developments ahead of key data and the Fed minutes. Red across the board, with the Nasdaq shedding the most losses there, down 1.3%, followed by the DAX losing just over 1%. The S&P 500 down 0.9%. Losses deepened across the Atlantic as well, also following a sour lead from Wall Street and Asia. Investor jitters centered around stretched valuations in both banking and tech, pushing sector indices further into the red. Coming through with most of the losses on that front is the French CAC 40 down 2.2%, the German DAX losing just over 2%, and the FTSE 100 down 1.5%. Now let's take a look at what's playing out on the currency front. Now, the rand not really catching on to the sell-off. Yes, losing some steam, but pretty steady as investors awaited economic data, including inflation and retail sales figures, as well as an interest rates move on Thursday by the SARB. And with that, the dollar to the rand at 17.18, the pound to the rand above 22, and the euro to the rand close to 20. Now let's take a look at your other currency pairs. The euro to the dollar weaker at 1.16. The pound to the dollar at 1.31. Trading stronger though is the dollar to the yen, just above 155. We're now joined by independent analyst Sean Dendera. Sean, thanks so much for your time today. Now, as I mentioned, it's red across the board, left, right, and center. Worries about AI valuations, U.S. economy, and the Fed bank rate cut prospects really weighing on sentiment today. I mean, for the past 2 weeks, if we're being quite honest. I have to ask, are you buying into the dip? Because fundamentals haven't drastically changed.
All right. Firstly, thank you for having me. It is quite an interesting one, probably taking a more of a wait-and-see approach, purely because traditionally, towards the end of the year, markets tend to rally, and we are seeing that this is not happening this year. I mean, we're already in mid-November, so we do not expect to be seeing a rally going forward. Coming from the AI front and the market sell-off, if we look at the S&P 500, for example, this year, its growth from a proportion perspective has been driven, 34% of it has been driven by the Magnificent Seven shares, so the AI bubble, as we're saying. And we're seeing that in the month of November, you know, all your AI stocks are down about 5%, which is starting to expose, you know, people's portfolios that were invested in traditional type stocks. And with those traditional type stocks, you're seeing that, okay, there is a slowdown of the economy in the US, there's a slowdown in the labor market, and naturally there's always a knock-on effect on, you know, our local bourse and all the other European markets. So we have to wait and see what the narrative is coming out of the Fed. Like you mentioned, we don't expect to see any more aggressive interest rate cuts, because we need to, or they need to at least stabilize that economy.
While we might not get interest rate cut from the Fed, we are hoping for, you know, a young early Christmas gift from Sub-Governor Lechela on Thursday. All right, let's hit pause for now. Sean Dendera there is an independent analyst, and he brings us a full assessment that is of the day that was in trade at 6 p.m.